Thanks for being here. This is going to be the session on does a merger or sale make sense for my bank? If you were thinking this was cannabis or hemp, you're in the wrong session. You got to go back to the main one. And data analytics is next door to the left. I do have two of our partners here. Chad Flanagan is here. He's our partner in charge of our Fargo office. And then Dana Arith is also in the back, who also does a lot of M&A. And feel free to chime in, Dana. So, and as well as Jill here, of course. So thank you all for being here today. I do want to express my gratitude and thanks to Tony for making the trip up here from Minneapolis. We do like to get him back to his North Dakota roots once in a while, and he also will bring a lot of his expertise to the presentation. So thanks for being here, Tony. Ownership succession planning, I should say, is definitely one of the top concerns in the industry. Our FDIC panelists today mentioned it as well, and succession planning is typically a part of any of the strategic planning that we do for our bank clients. Succession issues have spurred a lot of bank sales over the last 5 to 10 years, as Dana and Tony can probably attest to. But what we're hoping to do today is to kind of give you a different perspective and hope that after this session you understand that there are other options to consider other than selling your bank, and hopefully maybe start talking about some of those other options. We do welcome your comments and questions at any time during the session. Because we are recording this, if you do have a question, Tony and I will have to remember to try to repeat it so that our listening audience can get the benefit of that.
I'm kind of just a guy roaming around with the microphone, so I can come find you too.
So this is the agenda that Tony and I put together for the session. We do plan to review the M&A trends, and I'm going to start us out with that, and then Tony will join us in some of the later part of the presentation. But certainly, Tony always knows he's free to add anything to the presentation at any time. We don't plan to review all of the M&A data that's in here. There's a lot of detailed stuff in the back of the materials if you've downloaded that. But we do want to do is have just a really brief discussion on what's driving M&A activity. We've talked about that every year, I think, for the last 5 years, but we'll kind of touch on that just to kind of get our framework back on it, and then really get into some of the ideas to consider if you would like to stay independent, and that's really what we're trying to focus on. And then we're going to wrap up the presentation. Tony's going to talk a little bit about some of the merger considerations. And when we're talking about a merger, we're talking what we consider to be a true merger. There's a lot of transactions out there that are called mergers, but there really are acquisitions. And we, at the end of the day, the bank that's being acquired is getting cash for their stock. And so it really is an acquisition. And there's a lot of regulatory, financial, and tax reasons for structuring transactions that way. But what we're talking about are transactions where at the end of the day, you're bringing together shareholder bases as well as the operational side of the bank. So those are the types of mergers that we want to talk about a little bit today at the end of our session. So with that, we're going to get into some of the M&A information. Part of our comments today are based on other conferences that we've gone to. I think the most recent one was the Bank Holding Company M&A session that was down in Minneapolis a couple of weeks ago, and I know some of you out here were at that session as well. But really, at that session, many of the presenters there talked about kind of the steadiness of the M&A activity that they're seeing, and the softening in stock prices for stock transactions and some of the reasons for that. We'll revisit some of that. I always like to start out with this slide. I know you probably can't see it back there, and you don't have materials in front of you, but there's the red line. Reflects the growth of bank assets in the banking industry. The blue line is the number of commercial bank charters, and then kind of a yellowish green line is the number of commercial bank charters with assets less than $100 million. And so, obviously there's what it does reflect is the consolidation. There's a decrease of 85 commercial banks thus far in 2019. This is through June 30th information, and of that, a little over half, 43 of them, there's a 43 reduction in the number of commercial banks under 100 million. So again, it's just a continuation of the trends that we've been seeing in the last few years, the consolidation of the smaller banks and consolidation in general.
And Tim, that's throughout the U.S., right?
Yeah, this is throughout the U.S. Yeah, this is the M&A landscape as a whole, exactly. Yep. So we're down, number of charters went from 4,715 down to 4,630, and the number of banks under 100 million went from 1,133 down to 1,090, just over 1,000 small banks or banks over 100 million. The other thing that that it does reflect, though, and we typically don't get into it a lot, is the return on average asset that the banks and for banks as a whole in the U.S., and we'll touch on this a little later, is 1.37 compared to 1.35 last year. So that, again, a nice strong earnings result so far through the first 9 months, and the return on average equity is about 12% again. The same as the prior year. So all positive. This is actually just kind of lay out what's happening in the national, from a national scene. And again, as again, one of the other bank regulators, I can't remember which one, mentioned that, banks are strong. I mean, banks have enjoyed some consistently strong earnings and asset quality, and we're not seeing anything different than that in 2019. This is only through June 30th. But, that reduction of corporate tax rates at the end of 2017 and the little bit of improvement in net interest margin we've had over the last couple of years has resulted in returns on average assets that are above historical averages. So, again, as I mentioned, the return on average assets for national banks as a whole is 1.37, so it's up slightly from the prior year of 1.35. Net interest margin has averaged about 3.37, so actually, based on the national numbers, it's consistent with the prior, with the prior year. Community banks as a whole are higher now. They're about 3.67, so about a third of a percent higher than the industry, than the industry as a whole. The average leverage capital ratio for commercial banks is 9.77. That's up from 9.66. And for community banks, that actually the average as of June 30th was about 11.14%. So and I know I think at one of our bank group meetings here earlier this week, I think Blake reported we had done a data scan on all the banks in the nation just to kind of see how they would come out with being able to meet the simplified capital requirement, the simplified capital bank leverage ratio model, and it looked like 85 to 90% of the banks in the nation should be able to meet that without any problem going to that simplified capital model. So again, just it does reflect the strength of the banking industry, that the asset quality information that's here as well all reflect that. It does reflect the consolidation. There was a decrease of 85 banks, as we mentioned on the previous slide. That is a net number. The actual, there were actually 6 new charters in the first 6 months of 2019. 6 de novo banks. There was 1 failed bank in 2019, which we hadn't seen for a couple of years. Actually, I don't think there were any in 2018. So there was actually probably about 90 mergers or consolidations in the year. North Dakota, state of North Dakota, the condition of banks also remains strong. Based on these condition ratios, banks are holding on to the net interest margin 4.04% this year, which is exactly the same as where it was last year for 2018. The return on average assets did dip just a little bit, went from 1.4 to 1.37. Capital ratios grew from 9.89 to 10.04%. So again, strong capital ratios. The asset quality ratios are all fairly strong as well. Loan charge-off provision to net charge-offs is down a little bit. So again, it looks very good. This doesn't reflect any consolidation. It's showing as of June 30th, we still had 73 charters in the state, which is where we were last year, but there is activity in the state. There's been a couple of publicly announced transactions. First and Farmers Bank is going to be merged with First State Bank before, that'll happen before the end of the year, as well as the Blackridge Bank merger that's going to close before the end of the year as well. So we will have some reduction in the number of charters by the end of the year. And we've also worked with a number of banks, that have, that are looking, that are expanding their operation and, doing acquisitions in other states, Minnesota and South Dakota, for instance, and Montana. So, there's more activity than I guess the number here shows, in North Dakota, and we expect to see that continue. Minnesota numbers are also strong based on these condition ratios. Banks, the net interest margin dipped a little bit, but very, still pretty strong, 3.93% compared to 3.95. The return on average assets slipped just slightly. It went from 1.33 to 1.29 in Minnesota, and core leverage ratio, that actually grew a little bit, went from 10.66 to 10.75. So still pretty strong, and the number of banks at the top there, which it does show here, it went from 279 banks to 273 banks, so 6 less banks, and And you'll notice that there was also a reduction of 5 banks in banks with assets of less than 100 million. So a consolidation at that lower level, and these numbers will move before the end of the year, as we're well aware of.
The one thing I would point out in Minnesota, it's compared to North Dakota. If you go all the way back to 2014, it's a drop from 323 banks to 273 banks, just a little under 20% for the bank charters in Minnesota, whereas North Dakota actually, when you look at it as a percentage in that 5-year span, it's a lot less. So
Yeah.
Minnesota has seen some significant M&A activity.
Yeah. Yeah, we probably had about a 10% reduction, something like that. Yeah. Some of the other transaction data, the whole bank deals. Yeah, again, we won't spend a lot of time. This is material that's in your materials if you choose to download them, or if you send me an email, we'll ship them out to you. We'll email them out to you. Nationally, the number of bank transactions, I mean, it appears we're going to be about the same place. We're at 182. This is as of September 5th. So we're at 182 transactions in 2019 compared to 265 in 2018. So I expect we'll be close to that by the end of the year. I guess what's maybe a little interesting is the size of the transactions. I don't know if any notice that. The banks, in 2017 and 2018, the average size of transaction was 545 in 2017, and it was about 634 million in 2018. In 2019, where the average size of the transaction is about 1.9 billion, and so I had to look into that to see why. And there were actually 4 transactions so far in the U.S. in 2019 that included banks with assets of more than 50 billion, I should say. And the biggest one being the SunTrust Bank acquisition. That was 226 billion. So obviously that kind of skews the numbers a little bit. And I think on the SunTrust one, the book, what I remember is the price to tangible book was about 178 or something like that is what I looked at on that one. But we'll get into that later. As far as the Midwest area, this is the 13 states kind of up in the upper Midwest here. Number of transactions so far to date, we're at 80. We're at 83 transactions when you include banks and thrifts as a whole. So I expect by the end of the year we're going to be close to that 2018 level of 116 to 120 transactions. Average bank size. The other thing that we look at here is, in 2017, the average size is about 288 million for an average size transaction, which is what you'd expect more in our Midwest bank sizes here. In 2018, it did grow to 465, and so far in 2019, the average size is around, is around 530 million. But again, there are three pretty large transactions for the Midwest. 3 that had assets of excess of $1 billion, and including Chemical Bank, which was I think about 21 billion. So again, that kind of skews the numbers and has an impact on it. So really the same story as nationally, we're continuing to see that smaller banks are getting acquired. And the reason for that is a lot of smaller banks are feeling that pressure to sell or to merge to be able to manage, their stress points. And they're, and as a result, that there is going to be a kind of a shrinking pool of those banks that, that are available. Now we're getting to some of the actual pricing data, and this one is the head scratcher for me. It reflects the decline or the decline in the average price for bank transactions. We, in 2017 we're at 175.7 or 175% basically of tangible book was the average price. 2019 it's 155. And again, this is the national information. The PE ratio, price earnings ratio, went from 24 down to 16, and when you look back on the condition information that we looked at, for Minnesota, North Dakota, and nationally, there's really no reason for that price decrease based on bank operations. Earnings are still the same as they were in the prior year. And I guess the theory that was discussed at the Bank Holding Company Association is you got to remember that the transactions that are getting reported are the public transactions. A lot of those are stock for transactions, and the theory is that the price has softened a little bit for some of the publicly traded banks that are doing these transactions. As a result, the price, they're pricing out the acquisition targets a little bit lower as well to keep their ratios, to get their price, the stock for stock ratios that they want, and that this really is maybe more of a correction. We had some pretty good increases here You know, we had a 19% increase from 2016 to 17. And a lot of that had to do with the tax, you know, the tax law change and the Trump administration coming in. We had another 7% increase from 2017 to 2018. And so this, you know, maybe it isn't too surprising to see that we have, you know, about 11% decrease so far in 2019. And you know, again, I don't think we are not seeing that in the community bank transactions that we're working in. And I do really think that this is really more of an anomaly for the publicly traded banks and the stock for stock transactions that are being reported. So theoretically, I do think that, you know, the bank pricing is going to continue to increase. You know, I view it more of a little bit of a correction in the publicly reported data. I actually did take a look at it as of 9:30 just to see what this information was as of the beginning of September 5th, and by 9:30 the average price went from 155 down up to 160% a book. So I would expect by the end of the year it'll probably be up a little bit anyway. But again, it was kind of a head scratcher when you see the performance information out there that there's no reason from a performance reason why we ought to see a dip in the pricing.
I think the key there, Tim, though, too, is just, again, this is publicly reported
Right.
information, I think, and Tim said it, but anecdotally, what we've seen in the private, smaller bank deals, there's always unique considerations, but pricing really hasn't dipped
Right.
at all.
Yep. And the transaction, the cash transaction, and that was actually talked about at the Bank Holding Company Association M&A conference as well, is that for the cash transaction pricing is kind of probably at a minimum kind of staying at the same level. Let's see. We did see the same type of change as far as the publicly traded banks in the Midwest, the upper Midwest section here. You know, we were at 2017 155 times tangible book and 160% of tangible book in 2018. 2019 we were at 136.9. So a little bit of a dip there. You know, again, we're not seeing that in the cash transaction that we're seeing. And we've seen the same type of thing in the PE ratios. You know, it went from 20 times earnings in the last 2 years down to 15.4. So I think it's time to buy if the prices are that low. You guys get out there and buy some banks. So, but no, I do think they're going to kind of, you know, rebound. And again, we're not seeing, you know, we're still seeing that 1.5 to 175, you know, as far as kind of an average price range, and in more rural areas, and probably 175 to 2 down, you know, more in the more urban areas. So again, we're not seeing that softening in the transactions that we're working on. This is just that trend again. So, you know, that dip kind of looks pretty obvious in this one here when you kind of see that trend. You got to. The only thing I was going to point out that when you kind of average out the price to tangible book for the whole period, you know, we're at 155 nationally here on this graph, 1.4 in the Midwest region here. You know, when you look at the average over that 11-year period, it's actually for nationally it's about 135. So we are still, you know, significantly above the average. It's about 135, and in the region, our region, it's about 130% of tangible book value. So, and the other thing to remember is, you know, this is you know, when they're showing the pricing, you know, this is a percentage of tangible book, and you know, so basically that means your bank equities less your goodwill, core deposits, and other intangibles are being taken out of the capital. In a lot of the pricing mechanisms that we see in transactions, if it is a pricing mechanism, is usually it's based on a tangible base capital, you know, which would be probably closer to an 8% number, and then the excess capital is either distributed out or paid out at, you know, no premium. So, so when you convert that to this graph, you know, you would expect these to be maybe a little bit less than what we're seeing in actual transactions, you know, as far as a pricing mechanism. Median. This is basically the same data though, just showing the price earnings. You know, and again, you know, it's showing the decrease here to 15 and 16 times earnings in the 2019 year. And again, the average is probably. Let's see, I did pull that number for the whole 11-year period here. The averages are about 21 times earnings nationally and about 18 times earnings in the Midwest. So again, we're significantly below that. So I did throw in a couple graphs that aren't in your materials. I just thought it'd be interesting to show kind of the de novo activity. So far, this is through October 21st. There's been 10 de novo banks in the nation, pretty much all out on the East Coast and the West Coast, with the exception, and there was one in Oklahoma City. And I really don't know the story on that one, but otherwise they've all been kind of East Coast and West Coast. And
That one's interesting.
yeah,
There really has been no de novo activity. We actually had been down to see the FDIC with one potential group with
yeah,
Eide in connection, but that kind of fizzled out, and there really hasn't been anything in the Midwest. But I think a lot of that has to do with, if you look at the charter numbers up there,
yeah,
if you've ever seen any of those maps, we were down in Arizona, and there's 15 bank charters total in that state. A lot
yeah.
of branches down there, but there's only 15 charters, and so I think some of the areas where they're doing de novos, there's a little bit more of an opportunity for a bank startup. There's still a fair number of charters in this kind of Midwest quarter, all the way from North Dakota down to Texas.
Yeah. And a big reason for that is there are a lot of charters in the Midwest. I did take a look at, if you look at all the charters of the 13 states from North Dakota down to Texas in the Midwest here, we got 60% of the bank charters of the whole nation in those 13 states. So there is a lot of banks in the Midwest, and a lot of them, there's still a lot of banks under 100 million, and it's still cheaper to buy a bank than to form a de novo bank with the capital requirements that they're requiring of.
And we have seen that. We have
Yeah.
seen some investor groups come in looking to just
Yeah.
buy a charter. If you can find a $25 to $50 million bank,
Yep.
At least in Minnesota, it's somewhere close to the metro. Some of the outside investor groups will come down and do that rather than trying to take the 2 years it would take to get it up and running, and then whatever the burn rate is. So de novos are still, at least in this region, stalled out.
Yeah, and I don't think we'll see any in as long as we still have a pretty good surplus of banks in the area here. This here shows this is just that whole de novo activity for the last 20 years. I just think it's kind of an interesting graph. I mean, you got to remember, if you haven't been in the industry very long, it might surprise you, but at one point there were 100 and some de novos a year being formed, and back in that pre-financial crisis area, before 2009. So I don't know if we'll ever get back to that point, but certainly the consolidation is going to continue up in this area. With that was really all we wanted to share on some of the bank trends information. Any questions on that before we kind of get into the rest of the presentation? The next section, we wanted to just talk about options for considering your bank investment, and kind of clumsy. I should have used what Aaron of the Federal Reserve said. He said, keeping community banks around. I like that. That may be a better title for this presentation. But we just wanted to talk, before we talk about some of the reasons why banks fail, we wanted to remind you why a bank investment is an attractive investment. As we just looked over, community banks are averaging a 10%, return on average equity. So when you compare that to the return on equity that you're going to get in the stock market, and especially a stock market that's experiencing the volatility we have right now, community bank investments, do provide pretty consistent returns and above stock market averages. So it is really a pretty attractive investment from that perspective. The tax law, we talk about the dilutive effect of the income taxes, but also, which basically we're talking about there is if you do decide to sell your bank investment, you're only going to have your after-tax proceeds to invest in a stock market. But from a tax perspective, the new tax law was really favorable for banks. The 20% qualified business income, banks qualify for that, so that's really attractive, and the 21% C Corp rate is really attractive. So really the tax law changes were really the banking industry really did benefit from them a lot, and is another good reason to stay in the banking. And again, we're going to kind of speed through some of these things. I think maybe the last one I wanted to touch, these are just some of the reasons to continue to hold, but the estate planning, and Ramona was just in here talking about some of the estate planning advantages, with the $11.5 million exemption roughly, there's a lot of our closely held bank owners that may not be subject to estate taxes, with that level of exemption, especially when you consider that's an individual exemption. So huge opportunities for people to be able to plan, to hold their, transfer their bank investment at death and get a step up in basis in it. So again, some pretty significant reasons to why you might want to continue to stay in banking and to hold on to your investment. some of the other reasons for continuing banking include, sometimes the bank just isn't in a position right now to be sold. If you've had a turnover in management, or you have some kind of regulatory issues, sometimes it's better to hang on to that investment and try to kind of get it back so that it is a more profitable bank and in a better position to be sold. And of course, we think banks are, we know banks are appreciating assets. A lot of the, we've been talking about the price, pricing of banks. Are we at the peak right now? I really don't think so. You remember that banks were selling back at 230 times times tangible book value, or 24 times, earnings, back in the earlier years. I think our growth trend is going to continue. So, I think by hanging on to your bank investment, you're going to improve your position on that bank investment if you hang on to it for a period of time. And of course, the market area provides for growth and profit opportunities. We are seeing a lot of banks that are taking advantage of the current market right now and acquiring some of the smaller institutions that do feel the pressure to sell because they're having difficulties dealing with some of the things we're going to talk about in a second here, and are growing, enhancing their market and their profitability by growing the bank through some acquisitions. Again, I know you guys know all this stuff. We've talked about this every year for the last number of years, but I just wanted to kind of touch on that before we get into some of the other strategies that we're going to talk about here to help. These are, and I think I can't remember which one of the regulators talked about, some of the primary reasons. These, I think, are probably the two biggest reasons, why we are seeing banks for sale. Liquidity of the bank investments is a huge deal, and management succession. And many times we're seeing banks that have shareholder bases that are aging. You have shareholders that are looking for some liquidity or want to do some diversification to help with their retirement, and a lot of times banks aren't in a position to help them with that, and so they kind of result to a sale to provide that liquidity to the shareholder base. And or maybe perhaps the bank investment has already been transferred on to the next generation, and they're no longer living in the community, and they don't feel the same the same loyalty to the community and to the bank organization, and they want to get some liquidity. We've run into the situation as far as management succession. The banks have been operating pretty well the last few years, and maybe they haven't taken the opportunity to invest in that next level of management. And I've actually had those discussions fairly recently with a couple of bank clients where they feel they need, they wish they maybe would have went back 5 years and maybe carved out some of that earnings that they booked to invest in that next level of management and to grow that next level of management, because they're at a place now where senior management is 60 plus, and they don't have anybody that can run the bank, and so they are feeling pressured to sell the bank. So these are probably the two biggest reasons that we see. And again, I think it was Dan that said, do yourself a favor and get get that succession planning working sooner rather than later, because it really is for your benefit of your organization long term, and we totally agree with that. Other reasons, these are other reasons that were mentioned, I think, also as far as why banks are looking to sell. I don't know that the regulatory burden is maybe as bad now as what it has. Certainly there's still a lot of regulatory burden, but I think we're seeing some changes. The new capital model, I think, will help a little bit, and some of the other regulatory relief that's being talked about. All in all, I think banks are a little more optimistic under the Trump administration than they were previously, and so it's still probably on the list. I think it's probably more banks that are dealing with technology issues, banks that are dealing, with finding personnel. The technology issue is a big deal. And they feel they have to make some pretty significant investments to stay up to speed on that, and that maybe they're not getting they're getting the return on their investment, and in that case, maybe there is a reason why they need to look for a merger partner to kind of to get to the size where they can be more efficient as a bank. But number one, I do think the main reasons why we're seeing is kind of back to that first slide, is the liquidity issues and the management succession issues.
I think that's right, and I think I think we have seen you know, it depends on where the banks are located at, but there are some banks too that sat out the recession and the pricing has come back up and that they're at a point where they think that they can get a high enough price. It
Yeah.
ties into liquidity, but there's some that are selling based on price alone.
Right.
And the charter structure is, it's time for maybe an investor group. You look at some of those de novos, and the old model was to start a de novo, grow it, and then cash out your investor group. There are some of those old de novos that are maybe sat through the recession and now are looking to get out.
Yeah. With that, I'm going to turn it over to Tony. He's going to talk about some of the liquidity, some of the options that you have for addressing liquidity. I'll give you that. You want to?
Oh, yeah.
You going to stay here?
I'll wander around up here.
Okay. All right. Okay.
So, and again, we've seen a lot of the M&A, but rather than talking through what do you do with M&A versus, just if you get to a point where do you sell your bank, that liquidity issue is such a big issue. It's been something that we've had a lot of discussions about. So what I thought I'd talk about is a little bit of, if you've got a more diverse shareholder base, if it's closely held and there's maybe only 3 or 4 shareholders, it's a little bit different situation. But where you've got that broader shareholder group that's maybe aging or have been invested for a long period of time, what are your options? And it's not an easy answer. It's a privately held organization still is hard to get cash out of, but there are some things that can be done that we've seen, and I'll kind of walk through each step because we've talked to different clients and we've seen them implement different one of these to varying degrees of success. And I want to talk about first the kind of the matching program first. That's kind of the baseline, easiest thing you can do, and it really is no more than the bank saying, look, if any shareholder's interested in buying stock, if it comes available, we can keep a list of those names. And if anyone comes to us looking to sell their stock, we can put those parties in touch. And you want to be careful, but it's trying to create at least some type of limited market for your shares. It's not publicly traded, but it is seeing if there's interest from some shareholders in increasing their stake. And then when there are shareholders who need to liquidate or looking to liquidate for whatever reason, it's putting those two in touch. The key here is, though, it's a privately traded stock, so you don't want to, the bank or the holding company cannot be seen as a broker-dealer as part of this. So typically we've got some guidelines that we talk through with the organizations that are doing this, because what they should do is they should make it known, and they can at a periodic basis just remind the shareholder groups and typically that's tied to initial announcement and then the annual shareholder meetings to say, just remember, we have or help facilitate a matching program, which is if anyone is interested in selling, we have a list of buyers who would be interested. We can get them those names. They can reach out. Or if someone is interested in buying or increasing their stake, we will get their name on that list. Other than that, the holding company needs to be careful that it's not helping negotiate the deal. It's not giving an opinion to value. It's not acting as a transfer agent for the money itself. Really, the only thing the holding company should do after putting the buyer and seller in touch, they strike their own deal. And once they've done that, now they're going to have to make sure that they're working through any type of buy, sell, or shareholder agreement. But once they've done that, the holding company's only concern is, has there been a valid sale? And if there has, give us the proper documentation and we'll transfer seller your stock ownership interest to the buyer. And that's really all that the holding company should be doing to kind of make sure they're not acting as a security agent. But again, that's a very simple program for organizations to have to provide at least some potential liquidity. The next type of liquidity programs that we see are different types of repurchase programs by the holding company itself. So if you don't have a list of shareholders who are actively interested in buying more stock, the holding company itself can look at whether they want to use some of their excess capital if we're talking about M&A, some holding companies have looked around, or organizations have looked around and said, "Yeah, we really can't find an attractive target," or I just had this discussion. I've had a bank client who's participated in, I think, 3 bids in a row. They've tried to be very conservative and fiscally responsible about how they submit the bids. They said, we're just not in the range that we're willing to pay. We're going to focus instead, rather than trying to keep doing M&A that we're not willing to pay what's required, we're going to focus, take that extra capital instead, and do some repurchase programs and increase the value of the remaining shareholders through that. And there's really 2 ways that can be done for a private holding company. The first is the buybacks, and the second is kind of a formal tender offer. And there's differences between the two from a legal perspective. The buybacks are really a much more open-ended, flexible program. And the key there is that it's not a set period. It's not a fixed price. It really is an ongoing consideration by the holding company in one of 2 fashions. The first is just letting shareholders know, look, if you have a need to sell, or if you're interested in selling, the holding company may consider on a case-by-case basis redeeming shares at a set price. And depending on what you have for a buy-sell agreement, there may be some latitude for what you can set for that price, and how you consider that. A lot of organizations may actually go a little bit further, and kind of as a policy, as they're doing some of their budgeting or at the start of the year, say this year, and they don't disclose this number to shareholders, but they'll say this year we're going to make available $500,000 or $1 million, whatever the number is, for stock buybacks if we're approached. Now, that's not going out and formally telling the shareholders that the holding company is specifically looking to redeem, but there's a number that they have in mind. If someone approaches them, then they have the authority to buy that back upon a agreed upon price. Again, the key from a securities regulation standpoint is that it's open and ongoing. It's not a fixed offer, and it's really the shareholder coming to the holding company instead of the other way around. There's always still regulatory considerations. The Federal Reserve still looks at, that there's the SR 904 that came out back in the recession about the need to consult with the Federal Reserve. And if there's a redemption over a certain percentage in any given year of outstanding stock, that requires Federal Reserve approval.
And where we have seen that work, these repurchase programs and kind of, the flexible ones, is that, if a shareholder needs some extra liquidity, there's the Section 302B, a disqualified redemption, and if you're redeeming less than 80% of their interest in an S-corp world, that's treated as an S-corp distribution. It's not treated as a gain or a loss on the sale of stock, and so there's some real advantages to doing a 302B election if you're an S corporation shareholder, to get some liquidity to one particular shareholder. That it's treated as a dividend to them, and so it's just a non-taxable distribution to them. And we've done that for some, a number of our shareholder groups, probably a few of them every year, where they have a shareholder that needs some liquidity. But that would fall under that, I would assume.
That would fall under, yes.
Yeah.
The other repurchase offer is actually a formal tender offer. And now this is governed by securities regulations, and this does have some guidelines that need to be followed around it, but it actually, it's somewhat open-ended. But this is more the concept of the holding company, instead of just having an internal policy of, if someone comes to us, this is the amount we have set aside. It's really making a formal offer to the shareholder group to say, this year we have this much money, we're going to make an offer out to shareholders at this price, up to, again, $500,000, $1 million, whatever the number is, and it's going to be offered to, again, at this price, to these shareholders, and you can tell them what the terms of that offer are and the period of time that it'll remain open. And the benefit of that is it does, one, it sets some guidelines around what the liquidity event is, It puts some pressure on the shareholders themselves to consider whether or not they want to opt out, but you get to set the guidelines on it. You can decide who, if it's going to be applied to any shareholders equally. So if you have 20 shareholders who come in and say, we want to participate in the tender offer, it can be done pro rata. Everybody gets 1/20th. It can be done pro rata based on shares. It can be done, we're gonna redeem the smallest shareholders first. The key is simply, when you go out with your offer, making sure it's very clear what the terms of that offer are, what the total amount is, what the price per share is, who gets to participate, and what's the order that they're going to be redeemed. And the key then is following the specific requirements from a Securities and Federal Reserve perspective. The Federal Reserve is going to have the same considerations, but the securities piece has some disclosure issues, fairly simple to follow, the biggest of which, it has to remain open for at least 20 days. And I'm going to speed this up quick because we're getting close and I'm not going to run us over. A couple of other liquidity solutions that we have seen. Capital raise, which seems counterintuitive, but we have seen a number of banks do capital raises lately connected to actual stock redemptions. And that seems counterintuitive, but actually having some portion of the proceeds of a capital raise go to a redemption can be a good thing for raising capital, simply because it shows that there is an appetite for liquidity on a potential somewhat regular basis. So depending on how it's structured and how the disclosures go out, it can show that there may be liquidity events at certain points in time. The other thing that we have seen a number of community banks look at or explore is ESOP formation. And we probably have 1 or 2 bank clients a year who look at starting an ESOP, and probably that many who actually do in a given year put an ESOP together. Now that can provide liquidity, but that's not an immediate answer. Again, that goes kind of almost to the succession planning. An ESOP can be beneficial for liquidity 5-10 years down the road, but the first year you start an ESOP, there's not going to be necessarily a whole lot of liquidity with the ESOP.
Right.
So those are some things that we've seen. Again, the remaining options, really, from a liquidity standpoint, if you get through those as a private company, the only other options, there's always the option to do a quasi-public offering rather than actually register. There is the ability to be traded on the pink sheets or other. That's an involved process. And then there is the option to do an initial public offering. We have seen some of those for the larger banks. Alaris just did one, but that's with the security regulations now. That's such an involved process. There's not a lot of smaller banks where that's a realistic opportunity.
Right.
So, again, our presentation is focused on then, well, what are some other options? And this is something, if you were at the Bank Holding Company Association, we presented on this. Paul Sirik and I talked about a case study of one bank in particular that we've worked with, but we've had a couple of others. One, Southern Minnesota, where they've looked at, we don't want to exit the banking space, but we have some issues that we can't solve on our own. And they're trying to figure out what they can do. Small mergers, and again, Tim was specific, when we're talking about mergers, in a lot of transactions, they structure it, they call it a cash forward merger, meaning at closing, one institution merges into another. That's the legal structure. But the institution that gets merged in, their shareholders all get paid cash, and they're out. So while it's technically a legal merger, that's not the type of merger we're talking about here. We're talking about really 2 organizations, 2 shareholder groups partnering in some form or fashion. And that's not an easy thing to do. It takes a very specific set of banks. They have to find the right relationship. But if it works, it can be a very beneficial thing for both organizations. Again, we put up some of the reasons, but what can happen if you find the right partner and you can get comfortable, get a working relationship, is ultimately that the whole is greater than the sum of the parts. And in the specific cases that we've seen this work, one thing that was solved for was one bank had a clear succession planning issue, but had some excess capital and the ability to provide some liquidity. And the other bank had some succession, but an aging shareholder group where some of them were looking for some more liquidity than they were able to provide at the time. And when we talk about merging the groups, it doesn't mean it has to be pure stock for stock. Some of the transactions that we structure, and there's still going to be an organization that survives, but we have seen part cash, part stock mergers, where in the particular case I was talking about, the surviving organization was the one with liquidity, so they issued shares, but then had 30% of the price paid in cash. And that's important. There is an exchange ratio where I think you have to have at least 40%.
40% stock, yep.
Yeah, for the stock exchange to be tax-free. The cash is always taxable. There's always a basis gain on that, but that is important. The couple of keys in any transaction like that, and this is hard to distill down into a 5-minute presentation, but a couple of keys. One, finding the right partner. I talked about that. But then from the get-go, understanding what you have for some type of shareholder agreement that the two merged shareholder groups are going to have to live with. Because there can be very different cultures. It depends on how freely transferable one party's stock is versus another. There's a lot of issues to resolve there. And then really the biggest in any of these comes down to what we call societal issues. And it can be things like, what's the surviving name? Whose name survives? Who's going to be the president? Who's going to be the CEO? Who sits on the board of the bank? Those type of societal issues are things that you have to address up front. And that's where finding the right partner, discussing those, and seeing if you can make that work really becomes important. I'm gonna go through just again to the special considerations that come up, and this is true of almost any M&A deal, but certainly becomes more relevant if you're trying to do this type of thing, because both sides are going to have to understand when you're looking at doing a merger and you're getting stock instead of cash, it's as important for the seller to understand the buyer as it is for a buyer to understand the seller. Typically in a standard deal, if you're the buyer, you're going to need to do due diligence. You're going to want reps and warranties from the seller. There's going to be special covenants on how it operates. But if you're taking stock as part of it, you're investing in the buyer as much as they're investing in you. So you want, as a seller in that particular case, to know the same things about the buyer. You're going to want to understand what their plans are, what they're giving you for reps and warranties, whether there's any type of third-party termination or other issues that come as a result of that transaction.
Yeah. Due diligence is going to go both ways in these types of transactions. Yeah.
And I think that's important because it truly is putting the two together. And I'm going to flip back just one last piece, because the piece that comes in too is that the valuation of the stock, it's not going to be one for one. There is going to have to be an analysis of what the value, the fair market value of each bank's stock is based on. And typically you need an independent third party to do that value, to have some arm's length. The parties ultimately have to agree on what the value of each bank's stock is so you can come up with an exchange ratio. But there's going to be things that go into what their trends are, recent losses are, what's the historical trading ratio. It's not a one-for-one proposition, and it's important for legal reasons that whatever's agreed upon be deemed fair to all shareholders, because there are rights triggered on whether it be North Dakota corporate law or Minnesota corporate law. There's rights triggered as to what minority shareholders can do if it's not deemed fair to all shareholders. So with that, I think I'm actually getting, because we have till,
I think we're done.
I think we're done. I think we're right at the minute. So if there's questions, you can certainly feel free to come up and catch Tim and I. We can
Yeah,
talk about
and
what we're seeing.
you know, when we work through, I mean, we probably look at a few of these transactions a year, and you know, many times by the time you get down and kind of plug in some values for them and look at the exchange ratios, you know, it's either not acceptable to one or the other and they go away. But we are seeing more and more of them. And like I said, Tony was involved with one with our firm here that happened just recently. And we are seeing more and more of these. And I think we will see more and more of these options, because it does allow those organizations to grow that organization and maybe address some succession issues, but, you know, also address the, you know, kind of the size issue so that they can better fund some of these costs that they have to deal with. So anyway, thank you for being here. We appreciate you guys being here, and see you at the reception.